Hey, Jordan from Condo here. It's been a while since I've been on the old YouTube here. Excited to be back. Want to start the new year off with sort of a market review, where we've been in the past year, where we're at today, and then talk about where I think we might be going in 2023 and beyond. And I also want to talk a little bit about where I'm seeing the best deals right now. And you know what? It's not in the pre-construction market. So let's hop over to the PC, get right into this. All right, so the first thing I want to do is just take a look at Trev's numbers. So the Toronto Real Estate Board puts out a monthly report. We're going to look at the December numbers. So these numbers that you're seeing on the screen here, December of 2022 versus December of 2021. The first thing I want to draw attention to is just the sales volume. So if you look at 2021 across the GTA, we saw 6,000 home sales. In 2022, last year, we saw a decline of almost 50%. So we only saw 3,100 home sales. And if you look at the year as a whole, the amount of sales volume really tapered off. So the first few months were really good, and then with rate hikes, everything really tapered off. And as a result, the year's sales volume was roughly in line with 2008. So very low volume. A lot of realtors out there struggling. You're gonna see that's one thing you're gonna see in this industry, is a lot of shakeup, a lot of realtors going back to their full-time careers and what have you. But let's talk about pricing, because that's the exciting stuff. So in terms of pricing, obviously it's no secret, the peak of the market was in February of last year. We have seen some price declines. It varies massively depending on which market you're in though. So if we look at the 416, sort of Toronto proper, you look at detached prices this year at 1.6, you look a year ago, we're only down 4%. So we're only down 4% December 21 versus December 22. What's more interesting is if you look at detached pricing in the 905s, so in your suburbs markets, you see a price regression year over year of over 16%. So core product is holding up a lot better than stuff in the suburbs, in the exurbs, in markets that are further outside of downtown. And then if you look at condos, because this report is going to be I'm a condo guy, so it's going to be primarily condo focused. Condos in the core are up 1.4% year over year. Nothing to write home about, but roughly prices are flat. Now, this is a great chart that Globe and Mail put out that shows, I'll explain the chart first. So on this axis here, you have the percentage growth in prices from the start of the pandemic, so sort of the pre-pandemic market, to the peak of our real estate market during the pandemic. So in February of last year. So start of pandemic to market peak. And then on this axis, you have the decline in property price from the peak, so February of last year through November of last year. So sort of the peak of the market to the end of last year. And what you notice, there's a pretty clear correlation. So the markets that did the absolute best in terms of appreciation, that ran the most from start of COVID to the market peak, are also the ones, generally speaking, that are seeing the most aggressive correction in price, which is exactly what we predicted on this channel. We've been talking about this for 2 years now. But you're seeing it happen in real time now. So areas like Hamilton, Barrie, that appreciated up to 80% in less than 2 years, which is just a crazy number to think about. Those markets are seeing most price regression, but by no means are they anywhere near pre-pandemic pricing just yet anyways. So if you've been following this channel for a while, you know I love this chart. This is the Whitby Detached versus the CO1, so the downtown core condo. I'll put up a map of CO1, but it's just a downtown Toronto condo. Average selling price in green versus the Whitby Detached selling price in blue. And you'll note sort of the pandemic hits here. You see a little bit of a flash crash. Volume slows to nothing during our first lockdown, and then Whitby Detached just takes off. Condos grind down in price anywhere from 10 to 15%. They've since recovered, and since they've recovered, since about February of the market peak rather, they've traded sideways, right? You see the massive correction in Whitby Detached, and Whitby Detached is still grinding lower in price, but at a much, much slower pace. So it appears by looking at this graph that most of the pain has already been felt, and the correction in price, if any, moving forward will be slower and steadier, which is a healthier market for everywhere. Nobody wants to get caught in a crazy upswing or a crazy downswing. Now, if you're surprised that prices have not exactly stabilized, but they're not flying through the floor right now, it's important to look at inventory, right? So buyers have left the market. There's very few buyers in the market, but there's also not that much inventory. So buyers are playing the wait and see game, but so are sellers. And as a result, you're not seeing any insane price discovery. Things are kind of relatively stable. So this is a great chart from Alex. Follow him on Twitter. He's got great analytics. If you look at the blue line, this is the properties for sale on the resale market across the GTA. And you can see here, inventory is pretty low, right? Inventory is pretty low. We're even below sort of our long-term trends. So there's not a lot of, and if you're looking for a home right now, if you are a buyer, you know this, there's very few listings on the market. It does depend on the market you're in. But for the most part, inventory is pretty thin. And if you look at the rental market, it's no secret, last year was one of the best years for condo rents in Toronto in a long, long, long time. So anywhere from 15, 20% rental price growth. People were 10, 15 offers, sight unseen, full years of rent up front, all kinds of insanity. Just a really unhealthy rental market. We've since seen rents sort of peak and stabilize as more and more inventory is coming on market slowly and steadily. And this is a trend I expect to continue into this year because of condo completions. And we will get to that in a minute. Just to further contextualize what I'm talking about suburbs markets versus core product, let's look at some peak to today price changes in listings. This is an example here. This listing in Caledon sold in February of last year for $1.65 million. It just resold for $1.2 million, so that's a $450,000 price difference, 27%. By the way, I'm cherry picking the worst examples here, and I will also cherry pick the worst examples for condos. Halton Hills, so in Georgetown, we've got this listing here, sold in March of last year, 1.5, just resold for 1.1, so down about $400,000, also a 27% regression. Generally speaking, the average is not down. Your average property in these markets are probably not down 27%, right? These are just sort of your choice examples of, you go on House Sigma, you go sold below bought, it'll show you the worst. So same thing for condos. I picked the worst performers. Here's one in Mimico. This one sold in February for $985, just resold for $900,000. So only a 9% difference in price. And worth noting, obviously buying power from February versus today is a lot worse than 9%. Right? So your buying power, your affordability is down way more than 9%, right? So it's worth noting that. Condos are certainly holding up better. Here's another example in the core, sold for $750, just resold for $700. Now this article has been making the rounds. Maybe 20, 30 people have sent me this one, all right? So good news for renters, record number of new condo units coming to the GTA in 2023, new data shows. So they're projecting that there's going to be 32,000 condo completions in the GTA this year, which would make it our all-time high in terms of new condo completions. And the thought process here is that, well, most pre-construction condos, the majority anyways, are purchased by investors. So this is going to flood the market with new inventory, causing condo prices to crash, or all of that inventory will make it to the rental market, causing rental prices to crash. The first thing I want to contest is just the sheer number or the projection. I just want to talk about the actual number to quantify, give a little context here. The last time we projected that many 32,000 completions was in 2014. By the end of 2014, we had actually only seen about 19,000 completions. So it's important to understand that these projections are not an exact science. It's really hard to project this stuff, and they are based on originally marketed occupancy dates from developers in Toronto. If you know anything about pre-construction condos, you know that we run late, always, right? I always tell clients, hey, here's what the developer is projecting for occupancy. Assume it's going to be a year late. Be ready in case it's on time, but assume that it's going to be at least a year late. That's just the reality. Unless it's like an 8-story boutique, something like that, it might be on time. But for the most part, we are very late in Toronto. Now, this doesn't mean that it's not going to be a heavy year in terms of completions. I still think we'll probably see 24, 25, 26,000 condos complete this year. But I'm not overly concerned about that figure, and I'll tell you why. The first reason is that most people buy pre-construction at the time of original launch or within about a 6-month window. So condos take on average about 5 years to build. So if you're closing on a condo today, you bought it in 2017 through 2019 most likely, and you paid much lower prices than they're worth on the resale market today. Now, obviously, we haven't seen any appreciation in the condo market in about 2 years. So you're not closing with hundreds of thousands of dollars in equity, But you still pay, for example, I'll give you one example. So in December of this year, I had 70 units closed. So 70 of my clients closed on properties they bought with me 2017 through 2019. All of them closed without a hitch, except for one unit that we did have to sell via the assignment market. And that one bedroom in particular that we assigned, we purchased for $398,000 back in 2017. We sold it on the assignment market for $525,000. And in the resale market, comparable buildings nearby, roughly the same size one bedroom will sell for about $570 to $600 in those buildings, even in today's market, right? So there was enough equity in the deal where my client could make a tiny bit of profit after commissions, after fees, after that kind of thing. And also the buyer of the assignment will get a pretty good deal. But here's where it gets interesting. That was a good price in a good building, bought at a good time, and bought a long time ago. Not everybody who's closing on their units today bought that long ago or bought at such a good price. In some instances, they may be equity neutral or only have a little bit of equity in the deal. So here's where this gets interesting. There are some people who buy pre-construction condos and never intend to close. I've always recommended against this because you can get caught in the exact situation we're facing today where the market's just not on your side. And so as a result, we are currently seeing more assignments on the market than I have ever seen before, probably by a factor of 2 or 3. In a typical market, when your typical 350, 400 unit building is completing, you might see 5, 10, maybe 15 assignment units available for purchase. These days, you might see 25, 30, maybe even 40 up on the assignment market. So as a result, the absolute best deals, the people who are feeling the most pain and where you can get where you can essentially get rock bottom prices is in the assignment market. And on that note, if you are looking to pick up a distressed assignment deal or just as an assignment deal in general, you will almost always pay less than resale market value. If you're looking for those deals, check the link in the description. I've put together a spreadsheet with all the information on the assignments I currently have and my team currently has. And if there's anything that interests you, you can reach out. Now, I want to share this chart with you because this is my favorite chart. This has been my favorite chart in the last couple of months. This is a chart of Canada's population growth over a long period of time. And what you can see is that we are at all-time highs right now. So in 2022, we saw 430,000 new permanent residents in Canada. The Liberals have bumped up our immigration targets and we seem to have no problem hitting them. And so in the future, it's projected we'll continue to see those numbers. However, at the same time as this happening, pre-construction is not a very attractive deal right now. And I know it's crazy for Mr. Pre-Condo to say that, but the truth is that new launches are priced considerably higher than resale market value. I've had a lot of people ask me, well, why don't builders just launch at lower prices? And the honest reason is most of the time they can't, because basically how developments work is you take your land cost, your hard cost, your soft cost, and you add a 15 to 20% profit margin on top, and then you launch at that price. Because in order to get construction financing to build the building, you have to have that profit margin. So developers' margins are thinner than they've ever been, and the city's constantly increasing development charges. So last year we saw a 49% increase in municipal levies. This year we're seeing inclusionary zoning, which adds about another 5 to 10% cost on your average building. So the cost to build is actually increasing, but investor demand is decreasing as a result of market sentiment and rates, right? So less investors looking to buy pre-construction, but you have to sell 70% of your building in order to start construction. So as a developer, what do? Well, either you launch at these prices and hope the market will absorb the inventory so you can build it, or you just don't launch the product. And we're already seeing this happen. So last year we were supposed to see 35,000 new condos launch in the GTA. We only ended up seeing about 25,000 come to market. This year will be very similar. I think pre-construction sales in general will be a very slow process this year. Nobody's selling out in a weekend like the good old days anymore. And because of that, we're going to see far less new product come to market, which means in turn, new housing supply is actually contracting at the same time as population growth is through the roof. So the long-term story for Toronto is as good as it's ever been. But in the short term, honest take, where rates go, prices will follow. So I think it's a little naive to think that if we continue seeing rate hikes, the property market's somehow going to turn around and rebound. I don't think that's a realistic take on the market. I think realistically, if rates stay pinned where they are now or continue to go up, prices will continue to grind down. However, if rates stop hiking or reverse, then I think there's a more positive short-term outlook. So suffice to say, my point is, over the short term, I think you're going to continue to see pain. If you want to take advantage of that, I would love to say that it's in the pre-construction market, but truthfully, you can find better deals in the assignment market and the resale market. You just have to have the cash available. So for example, if you're buying a $700,000 condo on the assignment market that's maybe worth, $750 in the resale market, you would probably have to pay $850 or more for the same unit in the pre-construction market. So you have to ask yourself, does a short period of increased interest rates and carrying a negative cash flow property during that period of time, is that offset by a $150,000 discount? In almost all cases, the answer is yes. And so genuinely, I think the best deals right now are in the assignment market if you're in a position capital-wise to take advantage of those. The other thing that I think will continue happening is I think downtown core product will continue to outperform these exurbs markets. There's still a large gap in terms of appreciation that happened through COVID. And so I think most of the pain will be felt in those areas that did the best through COVID. I think that's only natural. You're going to see mean reversion over time. And that's sort of my take on the market. Let me know what you guys think in the comments below. And if you haven't already subscribed, please do so. And I will see you guys next video.